breathe just for a second. Inhale, and now exhale. Feel that? That tiny space between the noise, between the last tick of the Dow and the first headline from Asia? That's where we live. That's where we need to operate. But it's getting harder and harder to find that silence, isn't it? The air is thick, thick with predictions, with forecasts, with the deafening roar of so-called experts, all screaming about what's next. You're sitting there, in the quiet glow of your screens, the numbers flickering like a digital campfire, and you feel that familiar knot in your stomach. It's a cocktail of anxiety and anticipation, a blend of fear and a desperate, gnawing hope. You've been scrolling, haven't you? Reading the big bank reports, listening to the talking heads on financial news, trying to piece together a map of the future from the fragmented, contradictory opinions of others. Recession is imminent. The bull market has legs. Inflation is tamed. Stagflation is the real threat. Each prediction pulls at you. Each expert opinion plants a seed of doubt or a blossom of greed. You find a thesis that confirms your own bias, and for a moment you feel a surge of confidence, a dangerous, fleeting warmth. Then you find an equally compelling argument that shatters your thesis, and the cold dread seeps back in. Your finger hovers over the mouse. Buy, sell, hold, do nothing? The paralysis is real. The mental exhaustion is profound. This script, this time together, is not about giving you another prediction to add to that chaotic pile. God knows you don't need another one of those. This is about changing the question. Instead of asking, what are the experts predicting? We're going to ask, how do I process these predictions without losing my mind? How do I build a psychological fortress that can withstand the storm of opinion, the whipsaw of sentiment, and the siren's call of the herd? Because here's the truth, they don't tell you on TV. The most accurate market prediction in the world is utterly worthless if you don't have the psychological discipline to act on it correctly. Or, more importantly, to not act on it when your emotions are screaming at you to do the wrong thing. The greatest edge you will ever have is not in knowing the future. It's in knowing yourself. So for the next hour, let's silence the noise. Let's turn down the volume on the experts and turn up the volume on the one voice that truly matters, the calm, disciplined trader that exists within you. We're going to walk through the major forces shaping our world, from central banks to artificial intelligence to the geopolitical chessboard, but we're going to look at them through a different lens, not as a set of instructions, but as a landscape of probabilities, and most importantly, as a series of tests for your own mental fortitude. This is your masterclass in navigating the narrative. This is about what's next for you. Chapter 1. The Symphony of Signals, Decoding the Macro Fog. Let's start with the big picture, the 30,000-foot view. Because before you can even think about a specific stock, a currency pair, or a commodity, you have to understand the currents you're swimming in. Right now, the global macro environment isn't a clear current. It's a swirling vortex of competing forces. Trying to find a single clean narrative is a fool's errand. And embracing that complexity, that uncertainty, is the first step towards psychological resilience. For the last couple of years, the story was simple, wasn't it? Brutally simple. Inflation is a monster. Central banks are the monster slayers. Interest rates are their weapon. Everything, and I mean everything, danced to that one tune. Now the orchestra is playing a dozen different songs at once, and you're in the middle of the dance floor trying to make sense of it all. This is where the first major psychological trap is set, the desire for a simple story. Your brain craves it. A simple risk-on or risk-off world is easy to navigate, but that world is gone, at least for now. Resisting the urge to oversimplify is your first job. So what are the competing instruments in this chaotic symphony? First, you have the percussion section, the relentless drumbeat of central bank divergence. The U.S. Federal Reserve, the European Central Bank, the Bank of Japan, the People's Bank of China, they are no longer marching in lockstep. The Fed is desperately trying to stick a soft landing, whispering about future cuts while terrified of reigniting inflation. The ECB is grappling with its own fractured economic bloc, where one policy simply doesn't fit all. And the BOJ? They are the wild card, tentatively stepping away from decades of ultra-loose policy, sending ripples through global bond and currency markets. Your emotional response to this is likely whiplash. One day, a hawkish comment sends your growth stocks tumbling. The next, a dovish hint from another continent sends them soaring. The psychological toll of this is immense. It creates a sense of randomness, of gambling. The key here is to zoom out. Stop reacting to the daily beat of the drum and start listening to the entire rhythm over weeks and months. Are the banks, as a whole, still tightening the liquidity spigot, or are they slowly, cautiously beginning to open it? Don't get caught in the noise of a single speech. Watch the trend of global liquidity. That's the signal. The daily chatter is the noise. Acknowledge the frustration, the feeling of being jerked around, but don't let it dictate your strategy. Anchor yourself to the larger trend, not the daily gyration. Second, you have the string section, playing the haunting melody of geopolitics and deglobalization. The narrative of a seamlessly interconnected world is fraying at the edges. We're seeing the rise of trading blocs, the reshoring of supply chains, and the weaponization of economic policy. This isn't just about tariffs anymore. It's about who controls the semiconductors, the rare earth minerals, the energy flows. This creates a powerful psychological temptation, binary thinking. You might be tempted to think it's US versus China. I'll bet on one and against the other. But the reality is far more nuanced. It's a multipolar world. What about the rise of India, of Brazil, of Indonesia? What about the companies that are masters of navigating this new fractured landscape? The logistics wizards, the supply chain consultants, the companies building factories in Mexico or Vietnam. The emotional trap is to pick a team. The disciplined approach is to identify the consequences of this fracturing. What sectors benefit from redundancy? What materials become more valuable in a world of insecure supply? Don't bet on the horse. Bet on the changing shape of the racetrack itself. This requires you to move past headline-driven anger or patriotism and into a state of cold, strategic analysis. Finally, you have the wind instruments, breathing the powerful, unpredictable force of technology, specifically AI. This is the theme that can suddenly swell to drown out everything else. It promises a productivity boom not seen in generations. It's a deflationary force that could solve the inflation problem for the central banks. It's a paradigm shift, and it is, without a doubt, the single greatest source of FOMO, fear of missing out, in the market today. You see a stock double in a month, and you feel a physical pain, a jealousy, a desperate urge to chase it, to get on board, no matter the cost. This is perhaps the most dangerous psychological test of all. The AI narrative is so powerful, so seductive, that it can make you abandon every rule you've ever set for yourself. You'll forget about valuation. You'll ignore risk management. You'll throw your money at a story, not a business. The discipline here is monumental. It requires you to separate the long-term technological trend, which is real, from the short-term market mania, which is treacherous. It means asking the hard questions. Who is actually profiting? Is it the companies making the chips? The ones building the data centers? The ones selling the software? Or is it a bubble fueled by hype and liquidity? It means being okay with missing the first 100% gain to avoid the subsequent 80% crash.
It means having a process for entering these trades with clear entry points, position sizes, and, most critically, exit points. Don't let the beautiful music of the AI revolution lure your ship onto the rocks. So you stand there, listening to this symphony. The drums of the banks, the strings of geopolitics, the winds of technology. Your job is not to predict which instrument will be loudest tomorrow. Your job is to recognize that they are all playing and to build a portfolio and a mindset that is robust enough to handle the harmony, the dissonance, and the sudden crescendos. Embrace the complexity. Acknowledge the uncertainty. That is your foundation.
Chapter 2: The Two-Headed Dragon: Inflation and Interest Rates. Let's zoom in now. Let's focus on the beast that has held us all captive for the last 3 years, the two-headed dragon of inflation and interest rates. For a while, we thought the beast was slain, that the hikes had worked, the dragon was retreating back to its cave, and we could get back to the fairy tale of endlessly cheap money. But it's not that simple, is it? The beast is wounded, but it's still breathing fire, and navigating its next moves will test your patience and your ability to separate signal from sentiment like never before. First, let's talk about the inflation head. We've come down from the terrifying peaks of 8, 9, 10%. The easy part of the disinflationary journey is over. That was the part driven by untangled supply chains and collapsing energy prices. Now we are in what the experts call the last mile. And this mile is uphill, through thick mud. This is the sticky part of inflation, driven by services and a resilient labor market. It doesn't crash down, it grinds. It's stubborn, and it's agonizing for a market that craves the instant gratification of a V-shaped recovery. This is where the first psychological test for you comes in, the battle between patience and hope. Every month, you wait for that CPI report. You hope for a low number. You pray for it. A low print means the Fed can cut and the risk-on party can begin. When the number comes in just a little hotter than expected, even by a decimal point, the market throws a tantrum. Your portfolio takes a hit, and you feel that crushing disappointment, that sense of, when will this ever end? This emotional roller coaster, repeated month after month, is designed to wear you down. It encourages you to make impulsive decisions based on a single data point. Your defense? Redefine your timeline. Stop thinking in terms of months and start thinking in terms of quarters or even half years. Accept deep in your bones that the last mile is a grind. It will not be a straight line down. There will be frustrating upticks. The media will sensationalize every single report. Your job is to not participate in the monthly panic cycle. Look at the 6-month or 12-month trend in core inflation. Is it, despite the noise, still grinding lower? That's your signal. This requires a deep well of patience. It's like watching paint dry while someone occasionally throws a firecracker into the room. You have to train yourself to ignore the firecracker and keep your eyes on the wall. Now, let's look at the other head of the dragon, interest rates. This is where the divergence we talked about becomes critical. The market has been pricing in rate cuts for what feels like an eternity. The Fed pivot has been the most anticipated plot twist in modern market history. But what if the pivot isn't a single dramatic event? What if it's a slow, agonizingly cautious process? What if the Fed cuts once, then pauses for 6 months to see what happens? This scenario is a psychological nightmare for traders conditioned by the post-2008 world of immediate and overwhelming central bank action. The emotional trap is impatience. You might think, the cuts are coming. I'm going all in on long-duration assets now. You front-run the Fed. But if those cuts are delayed, or if they are hawkish cuts, where they cut rates but signal that's all for now, the market could react violently in the opposite direction. The pain of being right on the direction, but wrong on the timing, is one of the most acute pains in trading. It can make you doubt your entire process.
So how do you manage this? You approach it with a what-if mindset, not a what-is mindset. Instead of betting everything on one outcome, like the Fed will cut 100 basis points this year, you build a strategy that can adapt. What if they only cut once? What if they don't cut at all? What if, and this is the real black swan, they have to hike again? For each scenario, what does that mean for your positions? This is where you move from being a gambler to being a strategist. You might use options to define your risk. You might have a barbell strategy, holding some assets that do well in a high-rate environment, like short-term bonds or high-quality dividend stocks, and some that do well in a low-rate environment, like select growth tech. You aren't trying to be a hero who perfectly times the pivot. You are building a resilient portfolio that can absorb a shock. This doesn't provide the dopamine hit of getting a big bet right. Instead, it provides something far more valuable: staying power. It keeps you in the game, with your capital and your sanity intact, while the impatient and the over-leveraged are carried off the field. The dance with this two-headed dragon is a marathon, not a sprint. It will test your resolve. It will tempt you with hope and punish you with disappointment. Every headline about inflation, every word from a central banker is a psychological probe designed to find the weakness in your discipline. Your defense is to anchor yourself in the long-term trend, to plan for multiple outcomes, and to cultivate a level of patience that your competitors simply do not have. Let them burn themselves out on the monthly news cycle. You will be the one still standing when the path finally becomes clear.
Chapter 3: The New Titans. Technology, AI, and the Reshaping of Sectors. All right, let's shift gears. Let's talk about the force that feels like it's rewriting the rules in real time. The tectonic plates of the global economy are shifting, and the name of that shift is artificial intelligence. This isn't just another tech trend. It's a fundamental rewiring of how business is done, how value is created, and for us, how wealth is won and lost. And because the potential is so immense, it presents the most potent psychological challenges you will face as a trader: navigating hype, managing FOMO, and distinguishing a revolution from a bubble. The narrative is intoxicating, isn't it? You hear about AI adding trillions of dollars to global GDP. You see the demos, the instant code generation, the miraculous image creation, the hyper-personalized marketing. And you see the stocks. Oh, the stocks, the chip makers, the cloud providers, the hot new software companies. You see charts that look like rocket launches, and a voice in your head, a primal, greedy voice, starts screaming, "You're missing it! Everyone else is getting rich, and you're sitting on the sidelines. You're going to be left behind." That feeling, that sharp, painful anxiety of being left out, is FOMO. It is the single most powerful destructive emotion in financial markets. It has caused more people to lose more money than almost any other single factor. It makes you abandon your plan. It makes you buy high emotionally, hoping to sell even higher. It turns you from an investor into a gambler chasing a hot streak. Resisting this is not just a good idea, it is paramount to your survival. So how do you participate in a genuine technological revolution without becoming a victim of the mania that surrounds it? First, you must become a student of history. Go back and look at the charts of previous technological revolutions: the dawn of the internet in the late 90s, the railroad boom in the 19th century. The pattern is almost always the same: an initial surge of explosive growth and unbound optimism, followed by a brutal washout, a crash that wipes out the weak, the fraudulent, and the overhyped. Then, from the ashes, the real, sustainable giants emerge. Think about the dot-com bubble. For every Amazon that survived and conquered the world, there were 100 pets.coms that went to zero. Realizing that this pattern is likely to repeat itself with AI is your first psychological shield. It allows you to say, okay, this is a real revolution, but I do not have to buy everything that has AI in its name at any valuation.
It gives you permission to be patient, to be selective. It helps you shift from a mindset of, I have to get in now, to, I need to find the companies that will still be standing in 10 years. Second, you have to dissect the hype. You have to move beyond the top-level narrative and ask, where is the money actually flowing? Who is capturing the profits? This is the picks and shovels versus the gold miners framework. During the gold rush, most of the people who got rich weren't the ones panning for gold. It was the people selling the picks, the shovels, the denim jeans, and the transportation. In the AI revolution, who are the picks and shovels providers? It's the companies that design the specialized semiconductors, the GPUs. It's the companies that manufacture those chips. It's the utility companies that provide the massive amounts of electricity needed to power the data centers. It's the companies that build the cooling systems for those centers. These are often less glamorous, but they are tangible businesses capturing real revenue from the AI arms race, regardless of which AI model ultimately wins. Focusing on this layer can ground you in fundamentals, in profits and cash flow, rather than in speculative stories about future dominance. It's a way to invest in the theme without getting lost in the froth. Third, and this is the most difficult part, you must have a predefined process for risk management. For any trade you make in this space, you must know, before you enter, 3 things: your position size, your invalidation point, your stop loss, and your target for taking partial or full profits. The emotional pull of these stocks is so strong that you cannot trust yourself to make rational decisions in the heat of the moment. When a stock you own is up 50% in a month, the greed is overwhelming. You'll tell yourself it's going to double again, and you won't sell. When it suddenly drops 20% in a day, the fear is paralyzing. You'll tell yourself it's just a dip, it'll come back, and you won't sell. Your pre-written plan is your only defense. I will risk no more than 1% of my capital on this trade. If it closes below the 50-day moving average, I am out. No questions asked. If it reaches my price target of X, I will sell 1/3 of my position to lock in gains. Writing this down, making it a mechanical rule, externalizes the decision. It removes your flawed emotional brain from the equation at the most critical moments. It's the difference between being a professional and being a fan. Fans cheer for their team no matter what. Professionals have a game plan and execute it. Chapter 4. The Geopolitical Chessboard, Beyond the Headlines. Let's pull the lens back out again, but this time, let's look at the map of the world. For many traders, geopolitics is just noise. It's a scary headline about a conflict or a trade dispute that causes a sudden, unpredictable market spasm. You see red on your screen, you feel a jolt of fear, you curse the politicians, and then you wait for it to pass. But to treat geopolitics as just random noise is a massive mistake. It is the grand chessboard on which all economic activity takes place. Understanding the subtle, long-term shifts on this board can give you an edge that few retail traders ever develop. But it requires you to cultivate a very specific psychological skill: the ability to see past the loud emotional headlines and identify the quiet structural trends. For the past decade, the dominant geopolitical narrative was simple: U.S. versus China. It was a bipolar world, a new Cold War. This narrative was easy to grasp and easy to trade. Long U.S. tech, short Chinese real estate. But just like in the macroeconomy, this simple story is dissolving into something far more complex and multipolar. And the emotional trap here is to cling to the old simple narrative because it's familiar, or to react with fear and panic to every new headline that doesn't fit the old model. The first major shift you need to internalize is the rise of the middle powers. Countries like India, Brazil, Vietnam, Indonesia, Mexico, and Saudi Arabia are no longer just pawns on the U.S.-China chessboard. They are actively playing their own games, balancing alliances, and carving out their own spheres of influence. They are the new swing states of the global economy. For example, as Western companies diversify their supply chains away from China, the China plus one strategy, where is that investment going? It's flowing into factories in Mexico, manufacturing hubs in Vietnam, and tech centers in India. Your psychological task is to move from a state of headline-driven fear, war in region X is bad for markets, to a state of strategic curiosity. This tension is causing a reallocation of capital. Who benefits from that reallocation? Instead of seeing a news report about a new U.S. tariff on China and panicking, the disciplined trader asks, okay, if it's harder to import from China, which domestic companies will gain market share? Which companies in allied nations will see more orders? This transforms you from a passive victim of world events into an active strategist who sees opportunity in disruption. It requires you to do your homework, to look at trade flow data, to understand which countries are signing new trade pacts. It's work. It's less exciting than chasing a meme stock, but it's how durable long-term wealth is built. The second structural trend is the return of hard assets and resource nationalism. The era of frictionless globalization made us forget that everything we consume, our phones, our cars, our food, our electricity, comes from physical stuff that has to be dug out of the ground, grown, or drilled for. As the world fractures, the countries that control those resources have more and more power. This isn't just about oil anymore. It's about lithium for batteries, copper for electrification, rare earth metals for electronics, fresh water and arable land for food production. The psychological hurdle here is to overcome our modern bias for the intangible world of software and networks and to appreciate the grimy, cyclical, and often boring world of commodities and industrial materials. The narrative of a clean tech future is beautiful, but that future runs on an immense amount of copper, nickel, and silver. The AI revolution is powered by data centers that have an insatiable thirst for energy and water. The headlines may focus on the latest AI model, but the quiet, powerful trend is the rising demand for the physical inputs that make it all possible. To capitalize on this, you have to fight the urge to only look at what's exciting. You have to develop the patience to study supply and demand charts for raw materials. You have to understand the political stability of the countries that are major producers. This is a very different skill set than analyzing a software company's user growth. It requires a different temperament. It's a slow-moving game, but the trends, once they are in motion, can last for a decade or more. It's about recognizing that in a more volatile and uncertain world, the value of physical, essential stuff goes up. Finally, you must train yourself to develop a filter for geopolitical noise. 95% of what you see on the news or on social media regarding world events is designed to elicit an emotional response: fear, outrage, patriotism. It is not designed to make you a better investor. A politician's threatening speech, a minor border skirmish, a diplomatic insult, these things can cause a one-day market dip, but they rarely alter the long-term structural trends. The real signals are things like a country's long-term industrial policy, a major new infrastructure project, like India's push into semiconductor manufacturing, or a multinational treaty on critical minerals. Your job is to build a psychological filter. When a geopolitical headline breaks, take a breath. Ask yourself, is this just noise or is this a signal? Is this a one-day event that will be forgotten by next week, or does this meaningfully change the long-term flow of capital, goods, or resources? Learning to distinguish between the two is a superpower. It will keep you from panic selling the bottom on a scary headline and will allow you to calmly buy the dip, or even better, to ignore the noise entirely, confident in your long-term thesis. The chessboard is complex, but you don't need to predict every move. You just need to understand the fundamental direction of the game.
Chapter 5. The Inner Market. Mastering Your Own Psychology. We've covered a lot of ground. We've talked about the cacophony of central banks, the stubborn dragon of inflation, the seductive revolution of AI, and the shifting plates of the geopolitical chessboard. We've looked at the predictions and the cross-currents. And after all that analysis, What is the one single, undeniable conclusion? It's that the future is radically, fundamentally, and permanently uncertain. Anyone who tells you they know what's going to happen is either a fool or a liar. The web of variables is too complex. A single unexpected event, a new scientific breakthrough, a natural disaster, a sudden political crisis can render every forecast obsolete in an instant. And this is where we come to the final and most important section. This is where we stop looking at the external markets on our screens and turn our gaze inward, to the only market you can ever truly control, your own mind. Because if the external world is one of permanent uncertainty, then your only durable edge, the only thing that can protect you and allow you to prosper across any market regime, is psychological resilience. All the analysis in the world is useless if you panic at the first sign of trouble or get consumed by greed at the first taste of success. So how do you build this inner fortress? It's not about chanting affirmations or pretending you don't have emotions. It's about building a concrete, non-negotiable process that governs your trading actions. Your emotions can be the weather, stormy one day, the sunny the next, but your process must be the bedrock, the foundation that never moves. First, you must create what I call a trading constitution. This is a written document. It is your personal set of inviolable rules. It's not long or complicated. It should fit on a single page that you print out and place right next to your monitor. On it are the answers to fundamental questions you define for yourself when you are calm and rational, not in the heat of battle. Questions like, what is my maximum loss per day or week before I walk away? What is the maximum number of trades I will take in a day? What are the specific setup criteria that must be met before I even consider risking my capital? What are my rules for position sizing? Under what conditions will I never trade? For example, after a big loss or before a major news event. This document is your commander. You are the soldier. Your job is not to question the commander's orders in the middle of a firefight. Your job is to execute. When you feel that flush of fear and want to sell a position that hasn't hit your stop loss, you look at your constitution. The rule is the rule. You obey. When you feel that rush of greed after a winning streak and want to double your size on the next trade, you look at your constitution. The rule is the rule. You obey.